Ever wondered what would happen if you invested in high dividend stocks for half a year? Well, we did just that with BEPC, ENB, and NEE. You see, we embarked on a financial journey, an experiment of sorts, to see how these three stocks would perform over a 6-month period. Each of these stocks, Brookfield Renewable Partners, Enbridge, and NextEra Energy, are known for their high annual yields, but how would they fare in the short term? Would the dividends pay off, or would the risks outweigh the potential rewards? This video is our journey, our findings, and our insights distilled into valuable nuggets of wisdom. We'll be revealing the highs, the lows, and everything in between. If you've ever been curious about high dividend stocks, or just want to broaden your investment knowledge, this is the video for you. So, are you ready to dive into the world of high dividend stocks? Let's get started. Hey there viewers, if you're loving the content you're watching right now, don't miss out on all the upcoming videos packed with fresh tips, tricks, and inspiration. Hit that subscribe button so you can stay updated and be the first to know when we post new content. And don't forget to leave a comment and share with your friends. First off, we have Brookfield Renewable Partners Corporation, or BEPC for short. This titan in the renewable energy sector has been making waves in the market, and for good reasons. Operating across multiple continents, BEPC's portfolio is as diverse as it is robust, with a mix of hydroelectric, wind, solar, and storage facilities. For the 6-month period we're focusing on, BEPC boasted an annual yield that could make your eyebrows rise. We're talking about a substantial figure here, folks. Now you might ask, why BEPC? Well, the answer is simple. It's the combination of a strong commitment to renewable energy, a solid track record, and that irresistible annual yield that made BEPC a must-have in our experiment. But let's not just talk about numbers. Let's dig a little deeper into what makes BEPC tick. Founded in the late 90s, BEPC has been in the renewable energy game long before it was trendy. This isn't a company that jumped on the bandwagon. No, BEPC was driving the bandwagon. Over the years, it has demonstrated an unwavering commitment to sustainability and a knack for seizing opportunities in the burgeoning renewable energy market. Now, you might think that a company as established as BEPC would be content to rest on its laurels, but that's where you'd be wrong. BEPC is a company that's always looking forward, always innovating. It's not just about maintaining a lead in the renewable energy sector, it's about pushing the boundaries of what's possible. And that's what makes BEPC such an attractive proposition for investors. It's not just a company with a high annual yield. It's a company with a vision. A company that's not just riding the wave of renewable energy, but actively shaping the future of the sector. Impressive, isn't it? But that's not all. Let's move on to our second stock. Next up, we have Enbridge Inc., also known as ENB. Now let's dive into the intricacies of ENB. For the 6-month period of our experiment, Enbridge Inc. showcased a quite impressive annual yield. Now you may wonder, what makes ENB stand out? Well, the company operates in the energy sector, which is a critical industry that powers our daily lives. Specifically, ENB is a leading North American energy infrastructure company. It's involved in everything from the transportation and generation of energy to the distribution of gas and renewable power. ENB was chosen for this experiment for a few key reasons. Firstly, its stability. The energy sector, and specifically the infrastructure aspect of it, is known for its relative stability. This makes it a less risky choice for those who are dipping their toes in the high dividend pool. Secondly, ENB has been consistently paying out dividends for more than 2 decades, which is a testament to its reliability. During our 6-month trial, ENB's annual yield was noteworthy, offering a substantial return on our investment. The company's consistent performance, paired with its impressive dividend payouts, made it a star player in our experiment. But it's not just about the numbers. ENB also has a strong commitment to sustainability, with initiatives aimed at reducing its environmental footprint. This not only makes it a good choice for those conscious about the environment, but it also ensures the company's longevity in a world that's increasingly focused on sustainability. In conclusion, Enbridge Inc. is a solid choice for those interested in high dividend stocks. Its strong performance, consistent dividends, and focus on sustainability make it a standout option. Another great performer, right? But hold on, we have one more stock to discuss. Last but not least, we have NextEra Energy, or NEE. NEE is a leading clean energy company with consolidated revenues of more than $50 billion. It has a diverse portfolio, but the majority of its revenues are generated from wind and solar energy. Over the 6-month period, the annual yield for NEE remained relatively stable, hovering around 2.1%. Now you might be wondering why we chose a clean energy company for our high dividend experiment. Well, the reason is simple, and it ties into our overall investment strategy. We're looking for sustainable returns, not just quick profits. And in the long run, clean energy is where the future is headed. NextEra Energy, with its focus on renewable resources, is at the forefront of this energy transition. The company has demonstrated a consistent commitment to reducing carbon emissions and investing in sustainable energy solutions. This is reflected in its stable dividend yield and robust financial performance. In addition, NEE has a strong track record of increasing its dividends annually. This makes it an attractive option for dividend investors looking for steady income growth over time. In fact, over the past decade, NEE has grown its dividend at an average annual rate of approximately 10%. But let's not forget the bigger picture. By investing in a company like NextEra Energy, we're not just aiming for financial returns, we're also contributing to a more sustainable future. We're supporting a company that is actively working to reduce greenhouse gas emissions and combat climate change. And that, my friends, is a return on investment that can't be quantified. So there you have it. NextEra Energy, a clean energy powerhouse with a stable dividend yield, a commitment to sustainability, and a promising future. It's a compelling choice for any investor looking for high dividends and sustainable returns. Now that we've covered all 3 stocks, let's summarize our key findings. So, after 6 months of investing in these high dividend stocks, what have we learned? Well, first and foremost, it's clear that there's no one-size-fits-all approach to investing. It's about finding what works for you, your financial goals, and your risk tolerance. But let's delve a bit deeper into our journey. BEP Corporation, our first stock, presented us with an annual yield of 5.2%. It demonstrated a steady and reliable performance, underscoring the fact that stability is often a key feature of high dividend stocks. This makes them an attractive option for income-focused investors. Next, we looked at Enbridge Inc., which offered a whopping annual yield of 7.4%. Despite the higher yield, the stock's performance had its ups and downs. This showed us that while high dividend stocks can provide significant returns, they can also be more volatile and riskier. So it's essential to do your due diligence and balance your portfolio appropriately. Then, we explored NextEra Energy. With an annual yield of 2.7%, it may not seem as attractive as the other 2 on the surface. However, its consistent performance and steady growth highlighted the importance of looking beyond just the dividend yield. It's about the overall health and future prospects of the company. In summary, high dividend stocks can indeed be a lucrative investment strategy. They can provide a steady income stream and potentially high returns. However, they also come with their own set of risks and challenges. It's crucial to understand these aspects and make informed decisions. Remember, investing is not just about chasing high yields. It's about understanding the companies you're investing in, their business models, their market position, and their growth potential. So yes, our 6-month experiment has shown us that high dividend stocks can certainly be a part of a well-rounded investment portfolio. But like all investment strategies, they require careful consideration, research, and ongoing management. Intriguing, isn't it? How the world of high dividend stocks can be a game changer. Well, there you have it. We've walked through our 6-month journey with high dividend stocks. We've dived into the depths of BEPC, ENB, and NEE, exploring their annual yields and the intriguing surprises they brought. We've seen the highs and lows, and most importantly, we've learned that patience truly is a virtue when it comes to investing. Here's a special tip. Always keep an eye on the financial health of the company behind the stock. A high dividend yield is great, but it's not much use if the company is not stable enough to sustain it. It's all about balance. Remember, investing is not a sprint, it's a marathon. It's about making informed decisions, staying patient, and learning from each step of the journey. It's about creating a future that you can look forward to. If you found this video informative and helpful, don't forget to subscribe, like, and share. Stay tuned for more insights from the world of investing.